Good morning, I'm Richard Higgs, and today we're talking about tax year end. The clock's ticking, so I thought it'd be good to take you through a few potential ideas over the next few weeks, potential action points. There's over 1,000 tax reliefs out there. We're going to concentrate on the main ones to unlock today. If you are watching this on YouTube, just feel free to like and subscribe, or if you've got any comments or messages, just please make any comments, because that really helps us reach as many people as possible to help them as we approach tax year end. So let's start with the pension, the most tax efficient thing that you can possibly do. And you get tax relief on your income. So let's really go through the main thresholds that you need to look at. So the first threshold is the 12,500, your personal allowance. Everybody gets a tax-free personal allowance of 12,500. So if you have an income above that, if you make a pension contribution, that reduces your taxable income to potentially below the 12,500. So effectively that means that you wouldn't pay any tax whatsoever. So that would mean a really tax efficient way of reducing your tax. The next main threshold is the £50,000 higher rate tax threshold. So if you have an income over £50,000, you end up having to pay higher rate tax at usually 40%. So if you make a pension contribution, again, it'll reduce your taxable income to potentially below the 50,000, and then effectively you get tax relief at 40%, which is a really good deal. And then the final main income tax threshold is the 125,000 additional rate tax threshold. So for anybody that has income over 125,000, they pay additional rate of tax at 45%. So again, if you make a pension contribution, you can reduce that taxable income to below 125,000 and get 45% tax relief on that contribution. So amazing tax relievable investments through pensions. And things have just got better and better and better over the last year. The annual allowance, the amount that you can put into a pension and get tax relief on those contributions, has risen to £60,000. So effectively, most of us can put £60,000 into a pension each tax year and get full tax relief on it. If you are a really high earner, if you're earning £200,000, £300,000, that does get tapered down. So if you are in that category, definitely get in touch and we can kind of work out your tapered allowance. But for the majority of us, it's £60,000 that you can put into a pension and get tax relief. The other massive change this last year was the lifetime allowance has been abolished from April of this year. The lifetime allowance was the amount of pension that you could build up in your lifetime and not pay any tax on, over which you used to have to pay some extra tax charges. That's been abolished, so there's no upper limit now on the amount that you can put into a pension. So it really is a lot of good news in terms of pension contributions and what you can do before the tax year ends specifically to unlock those tax reliefs. And just to give you an example on how effective pension planning is, if you are a higher rate taxpayer pre-retirement, and then you're a basic rate taxpayer when you take your pension in retirement, just by putting money into a pension and taking it out again gives you a return of 31.25%. Literally just for putting money into a pension and taking it out again. It really is an amazing deal. And let's look at how tax-free the money within the pension is. So tax-free income, tax-free dividends, tax-free capital growth within the pension pot. It's inheritance tax-free. So, you know, pensions are starting to look like a like a trust fund. If you've got inheritance tax issues, or you're thinking about how to transfer tax efficiently your investments to future generations, a pension currently can be transferred completely tax-free to your children, to your grandchildren, and not have to pay inheritance tax. And there's some really useful other tax year-end tactical contributions that you can make. So, for instance, if your income is just over 100,000, or specifically if your income is between 100,000 and 125,000, the effective tax rate that you're paying is 60% between those two thresholds. That's because you start to lose your personal allowance when your income goes over 100,000, making the effective rate 60%. So if you could make a pension contribution to bring your taxable income to below 100,000, you're getting tax relief at 60%. That's 60% of money going into your pension and not going to the taxman. So that's an absolutely amazing deal. Again, if you've got income over 50,000, not only are you getting the tax relief at 40%, the tax, your higher rate tax, but also if you've got children and you're claiming child benefit, you start to lose your child benefit if one of your income goes above 50,000. That child benefit can be reclaimed if you put in a pension contribution, getting your adjusted income to below 50,000. And remember, you can also make gifts to children, grandchildren's pension plans. And as long as those gifts are out of income, out of your disposable income, that's inheritance tax free immediately, those gifts to a child's or a grandchild's pension plan. So it's another really great idea in terms of pension planning for you. So without labouring the point, pensions are probably the most tax efficient way of investing. But I would be remiss if I didn't mention the good old fashioned ISA. You get £20,000 ISA allowance per tax year. You've got a few weeks to go. If you don't use it, you lose it. So that's £20,000 of tax-free money, interest, dividends, capital gains, all tax-free within the ISA. And it's becoming really even more important now to use your ISA allowance, given that how the other reliefs and allowances have reduced so much over the last couple of years. So definitely use your ISA allowance for the tax year. You're running out of time for this tax year, so you need to kind of get things moving very quickly. You obviously have immediate access to an ISA, which is perhaps different to a pension. And remember, there's inheritance tax options with regard to the ISA. If you've got a normal cash ISA or an investment ISA, on death, that ISA will form part of your estate for inheritance tax, unless you do an inheritance tax-free ISA, which is basically investing your ISA in assets and investments and portfolios that qualify for something called business relief, which means that as long as you've held that ISA for more than 2 years, the ISA becomes inheritance tax-free. So if that's of interest, definitely get in touch and we can take you through some options. Or look at one of my videos that I've done on inheritance tax-free ISAs. Another option is an investment bond. So investment bonds are really simple and flexible. Again, there's inheritance tax options. They can be moved into a trust, right from outset, or moved into a trust at any time in the future for inheritance tax exemption. But because investment bonds themselves aren't producing an income or a gains, that's all happening within the bond. There's no ongoing assessments against income or capital gains. So it makes it really simple. You may not have to do it in a self-assessment form. And it's definitely becoming more and more popular given that what's happened to all the allowances and reliefs over the last couple of years. So that's investment bonds. And then finally, you've got general investment accounts, which haven't got any tax wrap around them. And then you're into the world of making sure that you're using all of your allowances. So the first allowance to think about is the capital gains allowance, which is the amount of gain that you can realise tax-free every year, which is currently 6,000. but it's reducing down to £3,000 in April. So if you've got a portfolio that's not in an ISA or a pension and it's made a gain of more than 6,000, definitely think about realising that gain this tax year to make sure that you're using that full 6,000. You could even sell down to 6,000, leave 30 days, that's the rule, and then buy back exactly the same fund, and then that's bringing your cost base for capital gains up. Obviously just make sure that you're comfortable with being out of the market for 30 days. But the main thing is to try and use that 6,000 tax-free allowance every year, if possible. Again, it's reducing to 3,000 next year, so the clock's kind of ticking on making sure that you get that allowance. Make sure that you're equalising your assets between husband and wife. So if there's the two of you, try and get those assets split so that you're using both allowances. So your capital gains becomes 12,000, your dividend allowance becomes 2,000. So everything gets doubled up by equalising your assets between husband and wife. Just think about losses. So, if you've made any losses on any of your funds or shares or portfolios over the last year or two, it's been a difficult time. Remember, those losses can be brought forward for up to 4 years, and that could become really important down the line if you've got some gains to realise. So if you have any losses, you're looking to use them, definitely get in touch and we'll be able to look into how best you can utilise those. And finally, back to pensions, if you do have any capital gains tax liability this year, perhaps some of it might be at the higher rate, 20%, some of it might be at 10%. By making a pension contribution, you could perhaps reduce your higher rate capital gains liability down to the lower rate, the 10%. Again, if you are in that position, definitely take advice on that one. Dividend allowance, it's gone from 2,000 down to 1,000 this year, and then it's going down to £500 in April. So definitely use your £1,000 allowance this tax year. And remember, on inheritance tax, we have a suite of inheritance tax-free investment options for you that qualify for business relief. So after 2 years of holding, they become tax-free. These are government incentives to invest in assets that are deemed priority for the long-term future of the country. So we're looking at, renewables, wind, solar power, property lending, property building, care homes, fibre broadband, anything that's a priority of the government. We have portfolios that qualify for business relief and therefore inheritance tax exemption after just 2 years, giving a return of 3 to 4% per year. So if you have, again, inheritance tax potential issues, definitely get in touch and we can kind of look into that for you. So today's been a very quick review of some of ideas and action points that you can potentially look at between now and tax year end. Again, if you're looking at this on YouTube, make sure you like and subscribe because it allows us to get out to as many people as possible. Leave any comments on the section below and any questions, and I'll definitely get back to you. But really, we're into the last month. There's still time to use some of these exemptions and allowances, especially with pensions, I would say, is the great opportunity, but also making sure you get your ISAs done as well. If you want to get in touch, don't hesitate to book an appointment with us and we can get that initial meeting in the diary. Do so quickly, just in terms of tax year end. And hopefully that's been of use to you. So we'll catch up with you on the next video. Thank you again. Cheers. Bye-bye. Bye.